Hey everyone, welcome back to The Explainer. Today we're doing something really cool. We're taking a comprehensive, multi-model approach to stock analysis. Using our provided stock data, we are putting Central Garden and Pet Company under the microscope. We're not just looking at your run-of-the-mill metrics here. Instead, we're bringing the heavy hitters into the boardroom, applying the distinct investment strategies of legendary investors like Warren Buffett, Peter Lynch, and Benjamin Graham, and then backing it all up with some rigorous discounted cash flow and comparable models. Let's just jump right in.
Here's the game plan for today. First, a quick company snapshot. Then, we'll look through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll crunch the numbers with DCF and comps, and finally, wrap it all up with our synthesis and final verdict.
All right, part one, company snapshot.
Right out of the gate, Central Garden and Pet Company, trading under the ticker CENTA, is currently sitting at a stock price of $37.77. Now, Wall Street analysts, they've pegged a target of $41 on this one, which implies about an 8.6% upside from where we are today. But look, we aren't here to just blindly trust Wall Street targets, right? We want to roll up our sleeves and understand exactly how to derive that value from the ground up.
To truly value a business, you gotta know what pays the bills. For Central, the revenue split is pretty straightforward. 58% comes from their pet segment and 42% from garden. They are a massive player in a $33 billion lawn and garden consumables industry. But here is the kicker, and you really want to keep this in your back pocket for later. They rely heavily on seasonality. I mean, we're talking about a staggering 60% of their sales and 90% of their profits landing in just the second and third fiscal quarters.
Moving on to part two, the Warren Buffett lens.
Okay, so if we hand the mic to Warren Buffett, you know the very first thing he's looking for is a moat, that distinct advantage a company has to protect its profitability. And looking at the data, Central actually possesses a really fascinating moat. They own over 60 high-quality brands and operate with this kind of duopoly-like scale in the incredibly resilient pet and garden spaces. I mean, people are always going to feed their dogs and tend their lawns, right? Central is deeply ingrained in those supply chains. Plus, Buffett loves honest management, and our source data highlights that their team has been remarkably steady and reliable through years of intensive M&A phases.
Let's run through the rest of Buffett's checklist using our source data. Scale leader? Yup, check. Their debt? Well, Fitch Ratings notes they maintain moderate EBITDA leverage comfortably below 4x, which Buffett would definitely deem highly manageable. Earnings consistency is absolutely there too, with a solid fiscal year 2026 EPS consensus target of $2.78. Plus, they boast a fortress of a balance sheet with really strong cash generation. And while return on equity isn't explicitly detailed in the base data, their historically consistent margins imply they're pretty efficient with their equity over the long haul.
Now, you know Buffett loves to calculate owner earnings, basically the true cash flow you can actually return to shareholders. Because precise owner earnings aren't handed to us on a silver platter in our standard source financials, we have to proxy it. So we start with their reported $371 million in adjusted EBITDA and then mentally back out standard taxes and maintenance CapEx. The conclusion? They generate plenty of cash to fund the operation. But knowing Buffett's legendary discipline, he's still going to demand a significant margin of safety on that initial entry price just to protect against any unexpected business hiccups.
All right, shifting gears to part three, the Peter Lynch lens.
Peter Lynch loves to categorize companies into specific buckets, like fast growers, stalwarts, or slow growers, just to figure out exactly what kind of game he's playing. So where does CENTA fit? It's kind of a debate between a stalwart and a slow grower. Currently, Fitch expects low single-digit sales declines down to roughly $3.1 billion as the company simplifies its portfolio amid some cautious consumer spending. Because of that sluggish top-line momentum, Lynch would almost certainly tag them as a slow grower right now.
Now, what's really interesting about this slide is how Lynch uses the PEG ratio, price to earnings divided by growth, to see if a company's growth is actually cheap. If we take their approximate PE of 13.5 and divide it by an estimated low single-digit growth rate, let's say 4%, we get a PEG ratio of roughly 3.3. For Lynch, anything over 1.0 is getting expensive. So at 3.3, that triggers a hard hold in his framework. While Lynch also loves to see heavy insider buying and low institutional ownership to confirm his thesis, our source data doesn't provide those metrics, so the PEG ratio alone drives our conclusion here.
Next up, part four, the Benjamin Graham lens.
Let's pass the baton to the ultimate value investor, Benjamin Graham, and check off his defensive investor list step by step. Adequate size? Yes, easily over $3.1 billion in sales. Earnings stability? Absolutely. They just reported top-line growth and margin expansion in their recent quarter. What about a moderate PE ratio? Graham wants it strictly under 15x, and Senta is sitting nicely at around 13.5x. So far, the company successfully passes his initial rigid quantitative hurdles without a sweat.
But let's get into the math and see how this builds his intrinsic value. Graham's formula is the square root of 22.5 times EPS times book value per share. Our EPS is $2.78. Since exact book value isn't in our snapshot, we have to make a logical assumption here. We're estimating an $18.88 book value based on a standard 2.0x industry price-to-book ratio. You run that through the formula, and Graham's intrinsic value comes out to a very precise $34.36.
And this brings us to Graham's absolute golden rule, the margin of safety. It's literally how value investors sleep at night. At a current price of $37.77, the stock is actually trading above our calculated intrinsic value of $34.36. Translated, there is zero margin of safety for a strict value investor today. Graham wouldn't touch this at current market prices. He'd be waiting patiently for a dip well below $30 before even considering opening a position.
Moving right along to Part 5, DCF and Alternative Valuations.
Let's move out of the philosophical frameworks and hand things over to the quants. To build our discounted cash flow model, we have to lay our assumptions clearly on the table. We're using a 5-year forecast window. We proxy free cash flow starting from that $371 million adjusted EBITDA. For our discount rate, or WACC, we are using 8.5% to represent standard mid-cap risk, and we're projecting a highly conservative 2% perpetual terminal growth rate. These are the bedrock figures that will determine if the cash this business generates is actually worth the asking price.
Now, you know DCFs are incredibly sensitive to inputs, which is exactly why this sensitivity table is so crucial. Check out the very center of the table. If you pair our 8.5% WACC with that 2% growth rate, our middle-of-the-road base case suggests a fair value right around $40 per share. But if growth stalls to 1.5% and risk jumps to 9.5%, that intrinsic value plummets down to $35.
If we pivot to an alternative valuation model, the comparable PE method, the math is super straightforward. We take our consensus fiscal year 2026 EPS target of $2.78 and multiply it by an assumed industry average multiple of 15x. This comps model arrives at a target of exactly $41.70. And honestly, it's pretty interesting how that aligns almost perfectly with Wall Street's $41 target that we looked at right at the beginning of our analysis.
Finally, Part 6, Synthesis and Final Verdict. Let's bring the entire boardroom together. Here is the ultimate takeaway, captured right here on our valuation scorecard. Notice how the modern quantitative models, the DCF and comps, sit right around $40 to $41. Buffett would likely find $40 fair for the economic moat they've built. But the stringent value guys, Lynch and Graham, see it totally differently. Lynch hates the high PEG ratio, and Graham's math demands an entry closer to $34 just to secure that all-important margin of safety.
Of course, we have to balance the synthesis by weighing the context behind the math. The bull case points to strong brand resilience, margin expansion from targeted cost initiatives, and really smart M&A integrations. But the bear case is very real. You've got intense weather seasonality tying 90% of profits to just 2 quarters, and a looming risk that the massive post-COVID surge in pet ownership simply normalizes and stalls out.
Bringing it all together, what is our final verdict? For the focused retail investor, Senta at $37.77 is a solid, undeniable hold. The current price perfectly reflects fair value based on modern cash flow models, but it simply lacks the deep margin of safety that gurus like Graham and Lynch demand before deploying new capital. To trigger a true buy, Graham would need it well under $30, and Lynch would need the price to drop significantly to improve that PEG ratio.
Look, Central Garden & Pet is undoubtedly a resilient, well-run company with an economic moat. But the overarching lesson from our guru boardroom today is that great companies only make great investments at the right price. It leaves you with a really critical question for your own portfolio. Are you paying for a company's past resilience, or are you genuinely buying its future growth? Think about that. Thanks for watching this explainer, and keep learning.